Good morning, ladies and gentlemen. Well, this is going to be a longer one because we have a lot to talk about. Last week, the yield curve warned us that something was going to happen, something dramatic, and indeed it did. What is not surprising to me is that the risk dial is looking straight through it. It is at 73, and if we look at what happened during the week, it's actually closed at one of the better scores, in fact, the best score of the week, despite the drop in SPX late on Friday. This is not an equity event. In fact, longer term, I think it's going to be very positive for equities, and that's why I call this the end of the beginning. This is no way the beginning of the end. I will now go through each component of the yield curve and what the bonds are telling us, because they warned us very, very well that something dramatic was going to happen. And I think what now happens in bonds is going to be absolutely key for the next several months, because it will dictate where asset prices are towards the end of the year. The only position I had going into the Fed was 2s10s, and actually, as it turns out, I should have been short 5s30s, which was my alternative, but I threw the coin and I got it wrong. 2s10s, I think, have actually given us the all clear. They are coming back down towards the 100 area. If we have a look at the monthly chart, and I will now change it, you will see how this is actually, this is going all the way back to 2002 and so on. We are going down, I would have thought, at least to the 100 area. This is a complete about face. What has the Fed done? The Fed has actually told us that it is prepared to act on any inflation uptick. And that has done two things. One, it has washed out positions which were on for many quarters, i.e. the steepeners of the yield curve. But the other thing that it has done is that it has shown us that terminal inflation is not going to be much above 2% over the longer term. That has caused people to get out of the front end, because if they tighten, the front end is going to go a long way, and we will examine each tenor later. And that tends to squash down the yield curve. Squashing down the yield curve is actually longer term positive for equities. In the short term, people have to get out of their positions and stuff like that, but we'll talk about that later. I think this move in 2s10s is going to continue until we get to about 100 basis points, or even lower down here to 75 basis points. Why? No way will, if there is inflation, and people believe that there is inflation, there is certainly some inflation, it's no way that one and done is going to do it. It's going to require several hikes in interest rates. Whether that happens in 2022 or 2023 is really not important. But it's certainly going to require several hikes, 3, 4, 5, until we get to a terminal rate of around 2.5%, and the yield curve can be absolutely flat at that level. But that tells me that over the next several months, the tendency for the yield curve is still going to be towards a flatter yield curve, probably one towards 0. This is a chart of the yield of the 2-year note. And, as I told you several times last week, as soon as we break this 19 basis points, it's going to go absolutely crazy. There were so many bad positions. You can see how long we've been in this very, very compressed range between, 12 basis points and 19 basis points. As soon as we broke it, I knew that the yield curve was going to go stupid. And this is basically what's happening. The 2-year note is now dependent on when the market thinks the Fed is going to A, taper, and B, much more importantly, raise rates. For the time being, 25 basis points is actually a little bit extreme, because if you think about it, 2 years out from now, as long as rates are going to be zero for, say, another 9 to 12 months, the break-even rate for the 2-year is not going to be much more than 25 basis points, because however much they hike, they're not going to hike in increments of more than 25 twice before this 2-year note expires. So 25 basis points is not bad. What we have now is definition. Every time it comes back to 1920 is going to be an absolutely wonderful short for, eventually moves back up to, into the 30s. What is crucial for the twos, as I've just told you, is when the Fed moves. We are not really going to have much more clarity about that until we get very, very good employment or very bad inflation data, which will accelerate the tightening cycle, or we get the opposite, in which case I think we come back down to, it's unlikely that we break 18 unless we get really fantastically bad data on the economy, and the Fed doesn't have to do anything for much, much longer than anticipated. But that, I think, is unlikely. The path of least resistance after a period of consolidation will again be up. I've been asked to have a quick look and comment about Eurodollars, and really basically the situation here is quite simple. The market is really expecting very little until the middle of next year. And you can see from the Fed funds rate really that we haven't moved at all for this year. And we are looking at the first increases in rates sometimes towards September of 22 to December of 22, with a complete certainty by March of 23. I think that is basically the timetable that we have at the moment. The Fed starts tapering sometimes towards the end of this year, beginning of next, and then interest rate hikes start beginning either end of 22 or beginning of 23. That is the state of play at the moment. It's unlikely that that will remain the state of play. Why? Because if inflation is happening, it's happening now, and the Fed will probably be forced to accelerate that timetable. There's no way that the market just meanders for the next 6 months within a very tight 10 basis point range. I think that is the least likely outcome. Either the data proves there is absolutely no inflation and it was all transitory, or, which is much more likely, it shows that there is inflation, there are problems with reopening, that the economy is strong, and the Fed has to bring forward its timetable, or the market demands that the timetable is brought forward. I think the current expectations of the market is probably the ones that's least likely to happen. This is EDU 22, so September 22. And, I told you, we are going, at some stage, we are going to break this line. And that will take us down, 20, 25 basis points. And don't forget that this market is now going to move in 20 to 25 basis point increments, because that is, one Fed hike brought forward and one Fed hike brought back. I think the brought back is very unlikely. I don't think I can enlarge this chart. I think the likelihood of September 22 ever going back to 75 over the course of the next 3-4 months is very low. But the likelihood of it breaking this level and going down another 20-25 is much greater. As you can see here, really, the hikes are baked in for H23, and you can see how the greens in 24 are already discounting everything, and they went slightly green on Friday. That tells me that the terminal rate that people are looking for in the short end is around 1.5%. So the people really in 2024 are looking for quite a flat yield curve with short ends around 1.5% and all the way out to 30-year somewhere just above 2. That's a very flat yield curve. It's a possibility, but I think there is a bigger possibility that in the meantime we accelerate this timetable, and really all the pressure comes into U22, H23, and M23, and you can see how M23 has, we go slightly sideways here, and then we break 99.15 in H23. That level is also very clear. It's going to be, I'm going to insert a reminder right here. It's going to be 99.32.5. I think it's very likely that we break these levels in the next 3 or 4 months and really go down another 20 to 25. Remember, these are going to be big moves. They're going to be big flattening moves in the yield curve, because now there is nothing to it. Either we get a 25, either the market discounts 25 basis points or it discounts 0. So there's not, you can see how the moves here were big, 20, 25 basis points. That is the kind of moves that we're going to get. The volatility of the euro dollars is likely to increase a hell of a lot. To help you understand what I'm saying, this is the 5-year forward inflation expectation rate that's available on Fred. You can see how over the course of the past couple of days it collapsed. That basically means that market participants are not looking for a terminal rate 5 years out of inflation more than it's collapsed back to 2.1% from, a few weeks ago it was 2.3 something, 2.38. It is unlikely. This just shows confidence in what the Fed has done. Talking about tapering, talking about rate cuts in late 22, early 23, whatever it happens to be. That has restored market confidence that they are in control. Unless we start getting some very bad data on the economy, it is unlikely that we go much lower than this. So basically, what did we do? We were losing confidence in the Fed. We were going higher, and now we're going back towards, we have confidence, and the Fed has succeeded in getting the terminal rate to around 2%. So that means that we are unlikely to go very much lower. And, we could be 10 basis points, 15 basis points, but that also gives you a floor for the 30-year note and for expectations of what the 30-year note will be. So if we if we change that to something like the 5-year forward, let's see how we enlarge this. Oops. You can see that is around 2% as well. This is the 5-year forward inflation. So everything is converging around the Fed's 2% level. If we change that to a 10-year break even, again, here we are, 2.2, 2.24. So everything is going, all the inflation expectations are going towards the 2% area. that really should give you a little bit of an idea where the floor for bond yields is, and I'll examine those next. This is a chart of the 5-year note, and really not a lot happened last week in terms of absolute yield movement in the 5-year. We had that big day on what was it, Wednesday, when the Fed spoke, and we went from basically 79 basis points up to 90 basis points, and we're still there. Now, the important thing about the 5-year note is that it gives you an idea of the cycle of the Fed tightening, because the Fed tightening cycle should be done within the 5-year note, the expiry of a 5-year note. So if we're saying 2 years of nothing, and then 1 year, 2 years of hike, and then another year or two of nothing, this is the rate that the market is telling you we will average at. I think that's probably a little bit optimistic. I still think that the path of least resistance for the 5-year note is going to go towards this 117 basis point area, simply because it's unlikely that it's a one and done. It's unlikely that it's a two and done. I think it'll probably take 3 or 4 hikes for the Fed to return to normality, get rates to around the 1.5% to 2% in the short end, and produce a fairly flat yield curve, in which case, I cannot be really bullish for the 5-year note in terms of futures prices. I still think that the path of least resistance for the 5-year note over the course of time is going to be higher, but I don't think that's going to happen now. As I told you, I think the Eurodollars are getting to an equilibrium level. We need to have strong data to accelerate forward the Fed tightening cycle. I don't think that's going to happen for a bit. So I'm fairly neutral for the 5-year note at these levels, just as I'm neutral for the 2-year note, as I showed you earlier. And if we examine the 10s and the 30s, you will see that they are also, very overbought, as it were, and the yields are quite low. What has happened is that we've had a humongous washout of very bad yield curve steepening positions. Given the fact that the inflation expectations are going to be, that I've just showed you, are going to be anchored around the 2 to 2.25 area, the likelihood of the 10-year note breaking 139 to me is quite low, and the likelihood of the 30-year breaking around this 190 area is also very low. You can see how, in terms of TLT, we are coming up to the top of the Bollinger Bands on the weeklies, and this one very important 148.90 level, which basically equates with 190. So, maximum another 10 basis points on the downside, and then I think we get a reaction. Everything is telling us that the Fed is going to have things under control, because they're going to A, taper, and B, tighten. And given that that is the situation, I really don't see why the yield curve should move very much in the next few weeks, while data comes out and either accelerates the Fed's timetable or negates it. In any case, I think from somewhere around here, volatility is going to pick up in the bonds, because either we go back to 225 if we have an acceleration of the timetable, or things are really weak and there is no inflation, in which case everything pancakes. So it's going to be a very interesting situation here, I'll enlarge the TLT chart right here. It's going to be a very interesting situation from this 147, 148 area, because either we come straight back down towards 136, 137, or if we just stay here and we have bad data, well then, the Fed doesn't need to do anything. And then but we have to go back towards a situation where the inflation was completely transitory. So either way, we're going to have a pickup in volatility. Inflation is either a worldwide phenomenon or it's not happening. There is no way that inflation in the US is going to be, 2% and is going to be negative 2% in Europe. They will equalize out, or the expectations of the market will be that they will eventually equalize out. I think that the likelihood of Germany and the EU rates in general not responding very similarly to with a bit of a lag, because let's face it, Europe is probably a couple of years behind the US in terms of growth and acceleration of the economy. The likelihood of therefore of the EU rates not responding similarly to US rates is not very high. There is to me a danger that we go back up to, this is the bubble, by the way, I forgot to say, that we go back towards a steepening tendency in Europe as well. The bubble is very well anchored in this range that we have done in the past couple of weeks. I think the likelihood of now breaking below 65 is, I think, very low. I think we are shifting towards a higher rate regime, and that at some stage we will try and test this 49 level. I don't think we, minus 49, I don't think we break it. I think we are now, as I said, in the US, we are now in a range. This is the Bund. I think we are probably in a little bit still of a steepening regime. I think that the likelihood again of breaking below these levels around 27 is quite low. I think that the market will start building in expectations that the next move from the ECB as well is going to be one of tapering. That doesn't mean that we go very far, but it just means that every time we get to lower yield levels, it'll be a wonderful opportunity again to start putting on short futures positions, because I'm sure that at some stage over the course of the next 2-3 months in the summer, we will be, as soon as risk off is off the table, we will be trading at these levels again. The one thing that I find interesting is this chart. That, as you can see, this is the differential between the US and Germany. It has come in naturally because of of what the Fed said, but I don't think it has that much further to go. I think these levels around the 153, 154 level are going to hold it in, and therefore the maximum further that I expect the differential to come in is another 10-11 basis points. Once that has happened, I think the natural tendency will be to go around back towards 175. So as you can see, I think there won't be much difference between what the expectations are in Europe and what the expectations are in the US. This is a phase where positions are being liquidated because they are very wrong for the time being, and that's all there is to it. Europe might be less volatile than the US over the course of the next 2 or 3 weeks, but that will normalize again, and I expect Europe to go for higher rates just like the US will. The theme of bad positions being liquidated in the wake of the Fed announcement last Wednesday, I think applies to the dollar as much as it applies to bonds or to equities. People started pressing their luck around the below 90. I said it's stupid to press your luck when you're in a range. And what is happening now, they're getting stopped out. Where is the stopping out going to end? Well, I doubt very much it's going to end before 93.14, and it's actually quite likely that we go to the intersection of these moving averages, which is going to be somewhere around here, 95. 95.37 looks pretty good. Just stopping everybody out. It's, I think, as simple as that. Will the lower dollar theme be negated? I don't think so. I think from a macro point of view, there is absolutely nothing to suggest that the Fed's policy has changed in terms of the level of inflation they want to achieve terminally, and I don't think anything has changed in terms of other central banks wishing to follow the same cycle as the Fed. In which case, as I showed you earlier, I don't think the differentials against the US dollar are going to move very far. And once this move is out of the way and people have been washed out and stopped out of their short dollar positions, I think the overall short dollar trend is going to reestablish itself. It's just a question of where. In the meantime, there's absolutely no reason to be short of dollars because I don't think that people have been carried out yet. Where will they be carried out? Is it quite possible that we take out the previous highs here around 94.65 over the course of the next couple of weeks? Absolutely possible. And then we are left with objectives which are quite a bit higher up. But on the dailies, I have my very, very important line here around 96.47, anywhere between 95 something, 95.50 and 96.37 is a level which is, to me, absolutely golden to go back short of dollars for the long term. It's going to be a while till it gets there. I'm not saying it happens in the next few days, but I think that we keep on stopping people out over the course of the next couple of weeks and do a higher dollar. If we don't go that much higher than we are at the moment, that will be another tell. It just means the positions have been washed out much earlier than I expected, and also there were not that many bad positions. Overall, I still am looking for levels to go short the dollar, whether that is 95 or 96, big figure, I don't know. But certainly in that area, I am a big seller of US dollars. I think that is where the trend really reasserts itself. In terms of Euro USD, where is the natural place for it to stop? As I said, the natural place, if you follow the logic of the DXY levels, is to stop all these people out here and really go into this box here, 115.30 to 114.35. That will have stopped everybody out. Everybody will start talking, head and shoulders, as they always do, and that will be the bottom, and then the trend will reassert itself. I think for the next few weeks you stay out. As I said, you stayed out here, you might as well stay out here and wait for this box here, because then that is where I think the trend for a lower dollar will reassert itself. It's a bastard to trade. Leave it alone. I would have thought that we get lower levels simply because the market loves stopping people out. I have zero doubt that the longer term trend is for a lower dollar. It follows from everything I've said about the dollar and the bonds that gold is not going to trade that well over the course of the next month or so. It's quite obvious, 1764 it traded very late on Friday, and I got picked up a little bit, but I'm only looking for a quick trade. I mean, $20 lower and I'm out. On a bigger picture in terms of the weeklies, it doesn't look all that promising. I have to say that the likelihood is that we test lower, and we test lower below 1700 in the next couple of weeks. I think as the dollar, as people are stopped out of their dollar positions, and as people get out of their steepener trades in the yield curve, there's going to be very little support for gold, and that is going to take us most probably down towards the 1700, and then probably even the 0.618 retracement of the whole move down towards 1600. Those are going to be wonderful opportunities to get long, but it really isn't a great market to hold over the course of the next few weeks. Eventually, yes, will it go back up above 2000? Yes. I mean, is it going to take a long time? Yes. Short term, given what I'm expecting for bonds, and given what I'm expecting for the yield curve, and given what I'm expecting for the US dollar, it's really not a buy and hold. It's a trading position. These levels down here are going to be long-term holds. These levels here, not so much. DBC also was naturally affected by the inflation expectations, but much less so than gold. And I still stick to my view that if you want to be long of some commodity or inflation hedge, inverted commas, DBC is a much better one than gold. What's more likely to happen here? Well, I would have thought more downside. I think people are long and wrong, and the downside is going to probably take us back into the levels that I was looking earlier. Can we do a mirror of this easily? High 16s, that kind of thing. So that is, in percentage terms, a big move, but in percentage terms in commodities, in DVC, not so much. Here, I think that's going to be a healthy consolidation for a few weeks, and months. It's going to be quite nice. So I really don't think that the upside is going to get tested for quite some time. The path of least resistance for DBC, I think, is slightly lower for the time being. You can see how much gold retraced against TLT, and it's more likely than not that we still have some room on the downside to get down to this 0.2162 level, where every time it breaks above it does something interesting, and every time it breaks below it does something interesting. The fact that these moving averages in a couple of weeks will be very supportive tells me that that is the level to actually try to go long of gold and short of TLT, which really tells me that my view that we still have another couple of weeks of weakness of gold, and to wash out positions in TLT is probably the right view, and somewhere around that 0.216 level it's going to be very interesting. I will place a a an alert there, and that is the level where I'm interested in buying gold against TLT, and I think that then we can bounce. That will probably be the best signal you're going to get that you're very close to a bottom in gold. I've been asked to comment about silver, and since I know absolutely nothing about silver itself, the only way that I can be of any use is commenting on its spread to gold. So if you have in mind what I've been saying about gold, and the spread here is silver to gold, so the higher means that silver is outperforming gold, and the lower it means it's doing worse than gold. It's been sticking around this 0.1486. Let me just enlarge this and see if you can see it better. This 0.1486 level has been very pivotal. This is now a 50-year chart. I will take it back. You can see how this level has been very pivotal for a very, very long time. And if we go back all the way back till when this thing started trading in '06, you can see that every time it's gone above, sometimes it's gone absolutely parabolic. That is basically all, and on the downside you can see how it stopped for a long time, and when it broke it, it went, kept on going lower. It seems that silver is in an outperformance phase to gold. It holds very well. So really, if you are bullish of something and you want to be long of something, it looks like silver might be a relatively better opportunity than gold if it starts breaking and staying above 0.1486 in terms of ratio of SLV to GLD. But that is all I'm prepared to say about that. I know so little about silver that I really don't want to give you a bum steer. Copper, bonds, the yield curve, even equities that we should see later are basically showing you all the same thing. Positions are being washed out. People have been long of copper for such a long time that this, Fed talk has actually, that people are liquidating. It's as simple as that. And when people liquidate in commodities and in gold, it tends to go further than one possibly thinks is possible. Could the and it's basically self-reinforcing. The more people liquidate in copper, the more people then buy long bonds, because there were long bonds because of there were short long bonds because the ratio of copper to gold was going down. So it's just a circular argument. This is a whole load of position liquidation, and the position liquidation is likely to last a little bit longer, simply because the market always goes to ridiculous levels before it stops people out at levels that it's convenient for them to be stopped out. So if I look at copper, I would have thought that we will trade down to here. This level of 367, that kind of level, 367 to 350, that is where natural support is going to be before we start going back up. This is a liquidation phase. Liquidations go further than you thought. It's as simple as that. Doesn't mean that copper's turned. It just means that this wave is over. We now get a retracement. This will be a great level to buy it. And really what I'm looking for from copper is a signal of when to go short the 30-year again. I would have bet that we are down here somewhere just when we are around just below 2% in the 30-year. That will align very well, and that will be the trade to take. Long commodities again and short the bonds. Okay, so what happened to equities last week? The same as in other contracts, liquidation. You have to understand that when people are, and hedge funds were completely buried in the yield curve, they ignored the warnings of the yield curve for the past 2 weeks that I've been saying to you. They ignored them. They got absolutely buried on their bond positions, and when they get buried on one position, they tend to liquidate in everything else. Just weight of money, weight of money, weight of money. That's why I've been telling you it's just going to go from one level to the next. It breaks that level, don't stick around, because liquidation always takes longer than you thought possible, and it goes further than you thought possible. It's just weight of money. The market wants to take it to an extreme level where things are really, really, really cheap. So, on the 195-minute chart, we are below the Bollinger Band, but we also close below the very important 4180 level. That to me says that we are going down to 4129, and then possibly at some stage we are also going down to this very pivotal 4068. I doubt that we can go below 4068. Let's try to figure out what the Fed actually said. The Fed actually said that it's prepared to act when the data show that it needs to act. To me, that is bullish longer term for longer term bonds, and i.e. it makes sure that the terminal rate at which inflation will peak is actually lower, right? Because if the Fed acts, that is good for long-term bonds, because the terminal rate of the whole move is going to be somewhere lower, or the market will have confidence that it will be lower. That means that you discounted equities by a lower price. That to me says that that is eventually bullish for equities, especially long duration ones, of which the United States is very heavy, i.e. the tech ones. So Apple, Amazon, things that are producing very nice, sort of that what their more or less what their earnings are going to be. They're going to be stable earnings, and in no way is a short-term rate of 1% or 2%, if the long-term rate stays constant, bearish for equities. I mean, is that the housing sector should now continue to be on fire because the mortgage rates are actually coming down or remaining stable, or there will be confidence that they will remain stable. So housing is going to be fine. If housing is fine, people are going to buy durable goods. If people buy durable goods, then the XLI eventually will stabilize. People will take out mortgages, everything is going to work well, then XLF will stabilize. This is not a recipe for much lower equity prices. This longer term has to be bullish. The question is, how long does liquidation last and where it stops? Is it going to stop at 41.29? Quite possibly. Is it going to stop at 40.68? I mean, how long is a piece of string? What you have to realize is that you want to buy it at those levels. When it closes through, you get out. One of these levels will stick, and it will stick big time, because this is not macro bearish for equities. It just isn't. In purely technical terms, and I keep on warning you that liquidations always go further than you thought possible and last longer than you thought possible. It's just weight of money. And sometimes, you just have to forget about what the macro picture is saying and see what the flows are, because there's no point being buried for weeks on end. So To me, if we close below the 41.28 to 41.14 area on this week, it's likely that we will come and fill this gap, which is somewhere around the 40.19 area, 40.20 area. So that is what the macro picture is saying. I still think that we will test this area next week between 41.28 and 41.14, and then we will get a bounce. What happens after that bounce is going to be absolutely pivotal. The spreads against technology tell me that a complete rout in equities is very, very unlikely. It's very unlikely unless you get a complete turnaround in the 30-year rates. As I anticipated, and I told you that it was more likely than not to happen, the QQQ has rallied against SPY simply because bond rates came down. Is it going to go a long way? Who knows? It's still in a tight range, and I think it will remain in a tight range for several weeks. What was obvious was that being long of Dow against the Nasdaq was really not a clever idea, and here we are testing some very important levels. I don't think next week we break them, and that gives me confidence that we are going to stabilize in the Dow. I will have a look at that later, but it just tells me that if long bond rates have a lower terminal yield, that is good for tech, and tech is, what is it, 15 to 20% of the SPX, and therefore that's going to be it's going to be impossible for SPX to just completely fall apart, because there is no reason for it. The flow, the stop out of positions is going to stop at some stage, at some level. People will find it cheap and money will come into it. It's just a question of when. If you look purely at QQQ and somebody asks you what happened last week, you'd say absolutely nothing. It basically closed where it opened, or very slightly positive. And the futures closed right on top of the very important 14,044 level. So there you have it. Just like when QQQ did this, XLF did absolutely nothing, and now XLF has collapsed because of, XLF will not go much lower, and QQQ has gone back up. It's rotation. This is not people getting out of equities. It's people getting out of bad sectors that they've had, and really it's just rotation. I think the rotation will continue as people get stopped out, but that does not mean that overall equities are a sell. I just can't see that. To me, that makes no sense. If we have a look at the Dow, well, what has happened to the Dow? The Dow broke out of this range. It broke out of the bottom of this. It's going to the 200-day moving average, and that is just because it's very financials heavy, and the financials and the industrials tend to move in the same way. And just as the Dow was outperforming, it's now underperforming. Does that mean it's a huge sell? No. To me, this means that we are reaching a very good value area in the Dow, and then at some stage it bounces together with SPX. That's all I can see there. If we look at, transports have done the same thing. They're breaking down, they're going down below. To me, this level here in Dow is actually going to be very important, 33,015. If all we do is we test it early part of next week and bounce, then we have some more time. And I really can't see that, look how oversold we are. I really can't see that we are going to fall apart in equities next week. To me, that is one of the least likelihoods. It just doesn't make any sense. The terminal rate is lower, and therefore that should support equity. equities. The weekly charts on the European equities are actually all the same as the US equities liquidation phase. How long does the liquidation phase last? Who the hell knows? It's likely that the DAX will test at least 400-500 points lower, and that we will go at least down into 39, the 3900s in the SPX. So 2-3% in everything. That is the equivalent of what, about 100 S&P points. It all comes back towards that 40, 50, 60 area at some stage in S&Ps. But the S&Ps started earlier than the DAX, so maybe they've got less to go. The one that I'm still looking for to give me a decent trading signal, nothing else, is the Nikkei. Below 2180, 28,180, I think we see this 26,940 level, and I think that's where we stop next week. That will be, so what's that? 1,000 points, 1,200 points. I think that's likely to happen. And if we don't break that level and close below 26,940, that will give me quite a bit of confidence that we're not going any lower than that 4068 level in the S&Ps. The VIX, it did close above 2005. It says pressure will continue. But what is pressure? How much are we likely to close these gaps around 22? I think we are. And don't forget there's this gap here in the high 27s at some stage. We could easily see it on a bust down towards 40-60 in the S&Ps. But overall, I don't think that this is going to be a lasting increase in volatility. I think we're going to have a few bad days for sure, and any dip down into the 18s is going to be a buy. But I don't think this chart is really warning me about an impending doom. I think this is liquidation. I think this is consistent. This level of volatility is consistent with liquidation and not with fear of macro developments. So to me, anytime we get up to here, 26 to 27 is a wonderful area to look for put spreads. That's really all there is to it. I think any times, as you can see, we get to 1558, that is just too low for this type of environment, and we're going to have reactions higher. All there is to be said about volatility, and I think all there is to be said about equities, this is a liquidation phase which has absolutely nothing to do with macro drivers. Treat it as such and you will pick up some bargains. To be able to differentiate between a liquidation, a position liquidation phase, and something which is more lasting, a macro driver, the important thing is to actually look at what is happening to the Blue Angels, i.e. the forward earnings expectations. Are the lines still rising, or are they beginning to turn over? Just like they were still rising here, and we just went to a lower level of multiple, or they started turning over here and then we collapsed to a lower level of multiple on a descending line. I think it's here that it's clear that we are just coming down to a lower level of multiple along a rising line, and that tells me that we will find support at some stage. The only question is which stage. We will try them all until one sticks. It's as simple as that. But from a macro standpoint, and also from a risk dial standpoint, nothing happened last week. Nothing bad for equities happened last week, I should add. To me, it's very clear that when the hedge funds liquidate very bad positions in bonds, they have to liquidate the whole, most of their portfolio is underwater. That to me is all that is happening here. Moreover, Deviations agrees with that view. This is not a bearish chart yet. Okay, in no way. I think, as you can see, the greens are between 40.80 and 40.50, call it. That is precisely where we have support. I don't think we break it. It's really the sectors which have moved and have done something caused this. XLU is already where it should be. BCXLK has done nothing as it should have done, and really it's XLF which had an absolute mare. But we are very, very close to levels where it should bounce, and that really resembles my view of the bonds, i.e. a little bit worse, and then we rally. I don't think that XLF is going to fall apart. There is absolutely no reason. A terminal rate of around 2% in inflation during a hiking cycle for the Fed is wonderful news for XLF. They're going to be borrowing at next to nothing, and they're going to be lending at 2%. It's certainly not news which causes it to collapse to these levels. I can understand a little bit of worsening, but an expansionary phase means absolutely very little credit pressure on the banks. To me, this is just nothing screams macro risk off. It just screams position adjusting. Well, I've put all the levels in the summary sheet. I think it's obvious that I can see continuation of liquidation of the dollar positions, continuation of the weakness in the equities because of liquidation, down to levels that I think are important, and those levels are 41.29 in SPX and 40.68. Anything around this 40.68 level, I think, is a wonderful longer term buy. But I still see weakness in equities because of it. I think the NQ is going to remain stable if we continue. EM should have done worse than it did, but it didn't. So I think it's remaining stable. But the fact that we have VIX strength, I think, is going to maintain the pressure down towards 40.68. The Nikkei is probably going to give us a decent trading opportunity below, if we trade below 28.180. We will see this 26.940 level, which I think is going to match up with 40.68 for a decent longer term buy. I think Europe is probably going to remain weak next week for the stocks. We had a weekly key reversal. I don't think that is that so important, but it just will exacerbate the liquidation that we're seeing. Overall, I don't think this is a risk-off situation. I think it's a get me out of here, book my losses P&L wise, and then we go again. Gold, I bought some at 1764 just for fun. $20 lower than that, I'm out. I think the likelihood of breaking 1810 to 1830.50 over the course of the next couple of months is very low. I think DBC is if you must have something in commodity land, it's going to be better than gold. Otherwise, these are my levels in the bonds. I really don't think that the yield curve, the 530s, can go much lower than this 105 level. At 105, I will try to go against it, and I would have thought if 105 matches with 40.68 and it matches with this with 26.940 in the Nikkei, I think that's going to be a wonderful level to go against it. Thank you very much. I will tweet all these levels to you when we get there, I really do think it's going to be a wonderful opportunity to get long of equities at these levels. Thank you very much indeed, and tweet you on Monday.